Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Good? Hope all is well out there. This is a quick show we call Fin Tips. Usually we share financial tips and tricks and things to try to help you out. So check out our playlist on YouTube if you're watching this there. Today we're going to go over some stock picks here. We're going to talk about a recent scan that we did. We pulled some data from S&P Capital IQ as well as some of the analyst ratings and put together a list of stocks that technically analysts believe that have the opportunity to outperform the market over the next year. Outperforming is just a very fancy way of saying they expect the total returns of these stocks to be greater than the overall market, and in this case, the market being the S&P 500. So we'll go through it. We'll share some of the information with you. As always, these are not individual recommendations. These are just a way for you to look at the market. Just interesting ways that you can kind of do your own analysis and see how people come up with ideas as they come up with them. And I'll share some of the tips and things that I have for you as well. All right, the first thing we did is we looked for stocks that had a dividend yield higher than the S&P 500. Not easy to come by these days, but we looked for high dividend and stable dividend type companies. In these days when the market's more volatile, a lot of people look towards those dividend yields as a way to sort of increase their total return and maybe offset some of the decline if it's a position you're planning on holding for a while. We also looked for the stock analyst ratings, and what we did is we looked for the consensus rating, meaning that all of them sort of agree on a rating, whether it's a buy, sell, outperform, underperform, etc. And so we said that all of them had to have an outperform rating. So dividend higher than the S&P 500, just all it had to be was higher, didn't have to be by much, and an outperform rating, which, like I said, the analysts believe that is a reason to, they believe that the stock will outperform the overall stock market. So let's share what we've got here on the screen. Here are the list of stocks with dividend yields over 2%, which is just over the S&P 500's yield. A little bit over 2% is where it had to be. And then we've, of course, got the ratings off to the side, so you can see the average rating for analysts there is at an outperform. One thing you're going to notice is that this is a very defensive list. And defensive is just a fancy way of saying these are stocks primarily that people are assumed to use their products during any economic period. So whether the economy is soft or whether it's doing really well, these are products that you're very likely to buy. For example, Pepsi, right? If you're looking at something like a Pepsi, well, you're probably going to drink Coke whether the stock market's doing well or the economy's doing well or is doing poorly. You may drink less of it or whatever, or look for a sale, but that's the general idea. So there's the list of stocks there. The goal was to find the most dependable, highest dividend-paying stocks with outperform ratings to see what could happen. If you break this into categories here and put it together as a portfolio, you can see that 51.8% of the portfolio is made up of defensive stocks. Those are your Coca-Colas, your Pepsi, ConAgra, which makes a lot of, Slim Jim and Marie Calendar, things like that, foods and things that you're expected to buy no matter what the stock market does. They're largely expected to be, we'll call it virus safe in this economy, because that's what's really pulled back our economy. We all know what's going on out there. So it's a largely defensive portfolio or not portfolio, but list of stocks overall. You're also going to notice healthcare in the list as well. You've got a couple names in there. You've got CVS. You've also got Merck in there as well in the healthcare space. If you look at CVS, they pay a 3.14% dividend yield as of now when we're taping this here. Merck pays 2.78%. Obviously, some nice dividends there and stocks that analysts believe will outperform the overall stock market over the next year. You're also going to see real estate in there, but I thought this real estate sort of response from this scan was pretty interesting. You've got PLD. It's in alphabetical order there. So you got PLD, which is Prologis. Prologis actually owns a bunch of warehouses, so this is not like an apartment type REIT or the traditional REIT that you may be thinking of. You also have Alexandria Real Estate, which they own medical labs. So they naturally popped up. Analysts were ahead of the game on this one. They think those will outperform, probably because they won't be hit as much as the other stocks. So you can see on those as well. Prologis paying out 2.3%. And then Alexandria Real Estate, 2.71% overall dividend yield at this point. So that's what you have there. You also notice you got a name like Home Depot there. And notice the analysts were pretty positive on that one. Did a little more research just to see what was going on. The argument there is the refinancing argument. I don't know if it's a good one. We'll find out. But the idea was if you're refinancing your house at these lower rates and you're pulling some cash out, there's a chance you may take some of that cash not only to survive if you don't have a job, but maybe to improve your home while you're sitting at home and have nothing else to do. Maybe you'll retile the floors or redo redo your bathroom considering the new refinancing cash that you have from the equity in your house. So that's that one. To take it a step further, we put these stocks together as an equal weight portfolio. So we said, okay, what happens if you were to just buy them all equal weight? To be fair, we had to give UPS a fraction of a percent more. It was just the last one. It was like 0.04 of a point there, so not that big of a deal. If we take a look at the portfolio as a whole, first of all, it has a dividend yield total of 3%. So if you put them all together, equal weight portfolio, it has a dividend yield of 3%, which is better than the S&P. You'd expect that because the dividend yield of all the stocks was above the S&P 500. Also is a little bit more volatile than the S&P 500, just so you know, even though it is defensive, there's some utilities and REITs in there. The portfolio as a whole is a little bit more volatile. Over the last 5 and 10 years, this actually has outperformed the stock market. What we're showing on the screen here is the 5-year performance on the screen. You can see that this portfolio mix would have outperformed the market by a few percent every single year. I'll have to put my cursor up here. So in the gray box up at the top, on the far right, you see ANN. That's the annualized returns of the portfolio and the S&P. Over the last 5 years, the S&P has annualized a return of 8.5%, 11% for this portfolio in question. If we look back 10 years, it also outperformed. It looks like a lot on the charts, but really it's just a couple percent, well, 3 to be exact, largely because of the dividend yield overall. So you can see why that may be the case. 14% annualized yields versus the 11.5 for the overall stock market. At the end of the day, this was just a kind of an interesting way to look at stocks. Hey, we asked a question: how could we find stocks that are expected to do better than the stock market and have some sort of backing so that it wasn't just our pure opinion? So we're using the ratings of the analysts, of course, in here. Price targets weren't so much in consideration at this point because we were looking for more outperformance, but we also added the criteria that it should pay a dividend yield of higher than the market. In a normal bullish market or a steady market, you may not have that as a criteria. You may just be happy with stocks that outperform. But in this environment, we thought, well, let's say that that's what we wanted to throw into the mix. It's something else that you can add to your scans if you're looking for stocks to invest in. I do have to mention, this is not an individual stock pick list, of course. These are not my suggestions. This is just the results of a scan of data that we pulled. So it keeps the regulators happy there. Well, I hope you enjoyed. Just a different way to look at things. Got just a short video here for you. Join us later for the closing beat at 5 o'clock live on our YouTube channel, where we go over the stock market and lots of great data and studies and things like this to help you better make investment decisions. If you need help with those investments, of course, I hope you'll check us out at jazzwealth.com, where we actually manage investments for individuals such as yourself. We are 100% fiduciary financial advisors. We're also SEC registered, so you know that the government is watching closely. And that's why I had to say everything that I had about saying today about, you know, maybe these aren't stocks that are recommended by me. They're just ideas and another way to look at things. All right, that's all I got for you. I will get out of the way because I'm no longer of use to you. I appreciate you watching. Hit the subscribe button and thumbs up button if that helps in any way today, because it does help us, and we'll greatly appreciate that. Enjoy the rest of your day, and we'll see you soon.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.